Hi, it's John Kelly. In this module, we are going to discuss Section 2400, the new standard on review engagements. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, I'm going to be discussing both the international standard ISRE 2400 and the Canadian standard CSRE 2400. In the big picture, the two new standards are identical. And indeed, you might even argue in the big picture that they really represent not much of a change from before, though there certainly is a significant change in the amount of documentation required. And the Canadian standard goes into more detail in a couple of areas than the international standard, and you could either view that as being helpful additional guidance or being inefficient. So we'll see as we go through. In any way, this just represents a continuing codification of best practice. Now, the standards are for financial statements dated on or after December the 14th, 2016 internationally, so it's in effect now for a December 31st year end, for instance, and December 14th, 2017 in Canada a year later. And you cannot adopt early. I was looking to see ways if you could practically do it, but the standards are different enough in their documentation requirements, new rep letter, new engagement letter, that you really just can't do it early, so we'll just have to wait. And as I said before, proper documentation is key. So we'll go through the sections and compare them. I've listed both the Canadian paragraph reference and the international paragraph reference, and we'll think about whether or not this requirement is the same as before, whether it differs only in a requirement for documentation, or whether it requires some kind of different performance in the doing of the review engagement. So first we are to comply with ethical requirements. I think that's the same as before. It was perhaps unstated, but it was in the various ethical requirements. We are to use professional skepticism and professional judgment. I think that's the same as before. Engagement level quality control is specified. I think that was implicit before. It was in the overall standard on quality control. It's now something we just need to make sure we provide a little more documentation of in the individual review engagement. And acceptance and continuance criteria, again, were in the overall quality control standard. I think that was implicit before. I actually don't think that's much of a documentation standard. I think you had to kind of follow that before. Anyway, if you hadn't been, that's something to update in your checklist. There's a requirement for a longer and more complete engagement letter, and as the engagement letter and the various paragraphs in it serve to protect the practitioner, a longer and more complete one is a good idea. It's only a documentation change. One caution, the first engagement letter you get in this new form needs to be dated before the engagement starts, so that it shows that you agreed the terms of the engagement with the client before you started. That's just a good idea to have your documentation appear that way. There's a requirement to consider getting an annual engagement letter. I've always thought an annual engagement letter was just good practice to protect the practitioner, so I will just continue to do that. There's a requirement to deal with changes to the terms of the engagement. I don't think that's something that will appear in the detailed checklist for an individual engagement, and I really don't think that's much of a change anyway. There's a requirement to tell management and those charged with governance of issues thought important by the practitioner. That would certainly be something that is best practice now. Because this requirement is in the standards, I think it's going to be important to have a checklist question that says something like, I told management everything I thought was important, or perhaps alternatively, there was nothing that I thought that was important to tell management, and so therefore I didn't tell them of anything. Because there could well be issues that were not terribly important that you either did or did not tell management about, but you only need to document in the file those that you thought were important, and you need to document that you told management about them. There is a requirement to document materiality. That's new. We kind of had to have materiality in the back of our head anyway if we were doing a review engagement to evaluate whether or not errors we found were material and absolutely had to be corrected or not. But the requirement to document it is new. And of course, a requirement to revise materiality as needed. Somewhat new, certainly in documentation, is a requirement to obtain an understanding of the entity and its environment, and they're using the audit terminology there, but there was always something of a requirement to do that before. This is new to identify areas in the financial statements where material misstatement is likely. The phrase risk of material misstatement is not used, material misstatement likely. And that is to be done to give a basis for designing the procedures. Now, that's kind of what we did before, but certainly this is much more specific of a documentation requirement, and certainly we will need to document areas in the financial statements where we think material misstatement is likely, though after you've done the bookkeeping for the client, I would suspect that in most review engagements you will not come up with any areas where material misstatement is likely, in other words, more than 50%, because we're probably going to consider that material misstatement is either low or moderate, and therefore not likely. There is a list of items that you need to document for your understanding, kind of business they do, are they incorporated or not, similar to before, but a bit longer than before, so something to revise in terms of checklist documentation to make sure that we've considered all the items we are supposed to. The Canadians decided to add a paragraph to say identify areas in the financial statements where material misstatement is likely. That really just repeats paragraph either 43 Canadian or International 45. They're just being more specific and I guess emphasizing that you would need to document that. But that's a difference between the Canadian and the international standard. We are to do inquiry and analytical procedures. That's the same as before, and inquiry and analytical procedures are very effective procedures at identifying errors, so that's a good thing to do. There is a list of specific procedures, things like related party transaction and going concern. Similar to before, we will need to make sure that we document that we have done all of those procedures, and that will require a checklist update. Consider if data from the accounting system is okay to do analytical procedures. Similar to the audit requirement where we actually have to do something to make sure that it's okay. This is the one thing I think where performance is different, though as the performance is only considering a checklist step that said, I considered whether or not data from the accounting system was okay to do analytical and concluded that it was, is a way of satisfying that changed performance requirement. Then there are more lists of procedures. The Canadian list is a little longer and more complete than the international list, so maybe if you are operating in an international environment, you might want to borrow the Canadian list. It's never a problem to do a few more things and document that you've done them. The Canadians also included a requirement to think about initial engagements and to consider opening balances and whether or not they met the level of a review. They'd been reviewed hard enough to make sure they were okay. A documentation thing, and I think only best practice. So I don't know that that's much of a difference, but it's certainly something that needs to be documented in a checklist in Canada and maybe internationally. A requirement to obtain evidence that the financial statements agree to the records. That's an audit requirement that they've placed in the review section. That's new, but seeing most review engagements are done by the client giving you their general ledger and saying, please prepare financial statements and do a review. That's kind of automatic. So again, documentation. Perform additional procedures if needed. That was always a requirement, so that's the same. If you find a problem, or you consider, said in the modern language, you find an area where a material misstatement is likely, you will do more to either solve the problem or dispel your suspicion. The Canadians have a requirement to accumulate misstatements. That's, of course, the same as practice. Documentation, I think even internationally you do that. Canadians have a requirement to tell management of the errors and ask that they be fixed, of course, and something you need to document. Then there's some paragraphs that talk about events between the date of the statements and the date of the report, and as a practical matter, it would be best if those were always the same. That's then trivial because there couldn't be anything because they will be the same. And dealing with errors found after the statements are issued, that's very rare and same as before anyway. Detailed contents of the rep letter, more than before, and that's why you'll need a new rep letter. In Canada, this is new and will be perhaps annoying. You will have to obtain a representation, as in an audit, that management says that the uncorrected errors are not material and you must include that list in the rep letter, like we do in an audit. Very, very good argument for just correcting all errors. Then you won't have to do that. Then there's a description of what you will do if management won't sign the rep letter. Short advice there is resign. A recommendation or a requirement rather that the rep letter date be near as possible to the financial statement date, and the same is best. And that's the same as before. Document that. You need to evaluate evidence and conclude. Then there are rather a lot of paragraphs that describe the new form of the report. A requirement, same as before, that we have all the needed evidence and the management rep letter before dating the report. And then a bunch of documentation requirements. We document the nature, timing, and extent of procedures, the results of the procedures, and a conclusion based on the procedures, and document any significant matters found. I think that's the same as before. Document who did the procedures and when. That's the audit requirement. I have always, since that audit requirement came in, I've done that in reviews and compilation engagements. And document who reviewed and when and the extent of the review. That's like the audit requirement, but we have to somehow or other document the extent of the review, and a checklist could help there. Document any significant matters, and a checklist to remind you to do that is a good idea. And document resolution of uncertainties. So the differences before, just to summarize, you have to document materiality. You have to document more of your understanding, and paragraph 44C and 46C will come back to. The requirement to consider if data is okay for analytical procedures, that's new. Longer list of procedures, you need to make sure that your checklist includes all of those procedures to remind you to do them. New rep and engagement letter, and then a longer, more audit-like list of things to document. So it depends if you had already kind of adopted that kind of audit approach in a review engagement, or whether or not that's going to be new for you. Canada and international differences, the initial engagement procedures, which is just best practice, and then including uncorrected errors in the rep letter. Those are the two big differences. Now, CPA Canada has provided lots of guidance. There's their website. And they had an audit and assurance alert in 2016. And there are two things that they said in that are just wrong. And I think we should point that out. On page 6, it says you must document all matters communicated to management. And that's incorrect. The standards only require that matters that are in the professional judgment of the auditor or the reviewer rather, of sufficient importance. So not all, only those of sufficient importance. And page 8 says you have to document the conclusion of your conclusion on the sufficiency of evidence. That's true, you do. But then it goes on, and they do this throughout their documentation. They say you have to document how the conclusion was reached. And that's not in the standards. The standards say document a conclusion on the results of the procedures, and that's all you have to do. So they've allowed themselves to get a little too enthusiastic, perhaps. The other document that they've produced is a guide to review engagements, 203 pages. The last one went onto the IASB website as useful guidance to everyone. So I think we might expect that it would end up there, so I'd like to talk about it. There are two items that are particularly I found helpful. One is that, and this is that paragraph that I mentioned before, we have to come up with and document an understanding of the accounting system. And the advice they have on page 64 is that's limited to how the client records, classifies, and summarizes things, and how the information is accumulated for the financial statements, and often that's done by the practitioner. So a brief statement, something like, the client uses QuickBooks, describe the accounting software they use, and reconciles the bank monthly, that might be sufficient to describe how they record, classify, and summarize, and how they accumulate the information for the financial statement. So I found that helpful, that there's not really a lot that you have to do to describe your understanding of the accounting system. Second thing I thought that was useful was how much do we have to do? We're required to consider whether the accounting systems are okay for us to use in analytical procedures. And page 86 lists the kind of standard things we do as analytical procedures, but does not suggest any specific documentation. So I think we're okay if we have a checklist step that says, I considered and I thought it was okay, and initial that, and that should meet the requirement it seems to in their guide. Now there are also some places where they really let themselves, I think, go far overboard. Page 55, for instance, says if you send a communication with those charged with governance only to the board chair, you then must document that you communicated with all board members, and that's just wrong. If you address a letter to the board chair, I think you have the right to assume that the board chair will share that with the board. Otherwise, you're assuming that the board chair is fraudulently withholding information from the board. So I think they've just gone a little overboard with that. Second thing they do is they require planning discussions and a planning memo, like in an audit. Page 14, they talk about team planning notes. Page 70, they talk about documenting planning in a brief memo, and they talk about this planning memo throughout. That's just wrong. There is no requirement in the standard for a planning memo. And indeed, if you take the standard and turn it into a checklist, you will end up with a section at the beginning called the planning section, and you will accomplish planning, but there is no requirement in the standard to produce a planning memo, to have a planning meeting. That's all an audit concept, and it's not required in the review standard. Several times in the document, they suggest you should prepare a list of all users. That's not anywhere in the standard as a requirement. I think you need to be very careful about listing users because you really don't know who's using the financial statements. And if you do want to list a banker as a known user, then presumably you're going to be liable to the banker, but you have not determined what it was that the banker wanted. So some danger, I think, there in listing the people you think are users, and you can make rather a long list of that. If you have a banker that is known and has known needs, you would absolutely, of course, need to consider that in doing the review. But if you can only foresee that a banker or a creditor or a potential purchaser might use the financial statements. GAAP, whatever framework you're using, whatever accounting framework, is determined by the standard setters to provide users with what information they need. So you don't need to do anything other than make sure that all the information required by the accounting framework you're using is present, and then you have presumably satisfied the list or the needs of all foreseeable users. Number of places they say you need to document your reasons. Again, that's not in the standard. Page 27 says you need to document your support for the conclusion on materiality, like you need to write a little essay about how you came up with it, not in the standard. You need to provide an explanation of why procedures are selected. So that's just not required. And it's not in the standard, and they've gone overboard. The other thing, procedures, this is somewhat self-evident. If you decided that the procedure was you wanted to ask the client if they reconcile the bank monthly, the reason was I wanted to know whether they reconcile the bank monthly. So I asked the bank if they reconciled the bank monthly because I wanted to know whether they reconcile the bank monthly is a little silly. So they've gone overboard. Where they've gone really, really overboard is how you document the procedures you are doing. And I think your first choice would be to have a checklist to remind the person doing the engagement of the inquiries they should make. And to the extent that the checklist can document that they did make their inquiries, if that's possible. Sometimes it is. Sometimes you need to provide additional documentation in the file. And you might even have your checklist direct the person that you need to inquire and you need to record what you found out. Sometimes you do, sometimes you don't. On page 93 and following, they use what I would call the essay method. And here is what they said on page 94 with respect to AFTA. And I don't actually expect that you can read that, but if you do go look at their document, it would take a long time to write that down. And there's all kinds of interesting information in there, though they do repeat 2 or 3 times something about a $3,500 recovery. And it looks very impressive, and you sort of go, oh, look at all that lovely documentation. But if you read it, you really don't find anything out about whether or not the allowance for doubtful accounts is adequate or not. You don't find out about whether or not old accounts have been allowed for. You don't find out whether or not they've gone through and reviewed and concluded that they have satisfactorily allowed. And we've made no comments about how, for instance, the aging of this year's accounts compares to the aging of last year's accounts. So it looks really good. It would take a long, long time, but I actually don't know that it's terribly effective or whether it really works. So it's wildly inefficient, lots and lots of words, but in the end, no conclusion that the allowance for doubtful accounts is acceptable or not. So, thanks for listening.